In yet another recalibration of monetary policy, Mary Daly, president of the Federal Reserve Bank of San Francisco, has signaled that further interest rate cuts could be on the horizon. Daly expressed optimism that this move would balance the goals of supporting the labor market while keeping inflation in check. But here's the real question. Is this just another attempt at kicking the can down the road? Or is the Fed steering the economy toward sheer instability? Let's break it down step by step, peeling off the layers of what might just be an economic disaster in the making. At first glance, Daly's comments on the economy seem to reveal the Fed's concern about a fragile labor market as inflation starts to cool. The decision to lower rates by 50 basis points last month sent ripples across global financial markets. However, the term recalibration, as employed both by Daly and Jerome Powell, the Fed chair, is injected with a sense of urgency to support economic growth. Let's be honest, under such circumstances, recalibration merely reflects the central bank's inability to stick with a consistent policy. It highlights a dividing struggle, often mirroring a deeper economic malaise. Getting it wrong might turn this economic balancing act into a free fall. Daly's visible apprehension lies in the labor market. She affirms concern about further slowing within the already weakened job market. But hold on, when exactly was this job market healthy to begin with? The U.S. labor market only looks solid on paper, with an unemployment rate hovering around 3.8% as of September 2023. But peel away those layers, and the underlying weakness becomes hard to ignore. Labor force participation is still notably lower than it was pre-pandemic, and the quality of the jobs being added to the economy has been declining. Meanwhile, the gig economy is in full swing, practically standing in the place of more stable, full-time employment. The rise of gig workers masks so many of the detrimental effects inherent to a sluggish labor market. No benefits, lower wages, no security, and absolutely no safety net when a downturn arrives. And there's more evidence. Job growth is increasingly concentrated in low-wage sectors like hospitality and retail, while prestigious industries such as tech and financial services are hemorrhaging jobs. Case in point, the tech industry layoffs surpassed 220,000 workers across the globe in 2023. Companies like Meta, Amazon, and Google all extended their job cuts well into the second half of the year. Now, once inflation cools, which it seems to be doing, you'd expect interest rates to adjust downwards, right? Well, not exactly. What people fail to account for is that even in today's climate of declining inflation, inflation-adjusted interest rates remain high. These higher real interest rates exert an undue drag on business investments and household consumption. Looking at inflation, yes, the headline Consumer Price Index, CPI, has drifted towards more comfortable territory, with the Fed's 2% target finally seeming achievable. But much of this has been driven not by genuine, organic economic growth, but by weakness in demand, especially in critical sectors such as real estate, where home prices have collapsed due to interest rate hikes, and consumer spending is likely curbed by fears of a potential recession. In a broader context, the Federal Reserve's rapid rate hike cycle since 2022, which saw the benchmark interest rate soar from near-zero levels to over 5% within 1 year, remains the largest monetary tightening policy in recent U.S. history. And now the music is slowing down. Daly's mention of 1 or 2 more cuts this year implies the Fed's acknowledgement that the tightening is possibly dragging the economy toward stagnation, or worse, a recession. But then again, where was the accountability? The Fed's stringent hikes came with expectations that controlling inflation was paramount, even if it meant cooling down the economy. But how much damage can such frenetic yo-yoing between rate hikes and cuts inflict on long-term economic planning? Business investment strategies have been seriously compromised. Homebuyers are hesitant, fearing further financial instability. Layoffs in previously solid sectors erode confidence. This perpetual back and forth between tackling inflation and trying to salvage the labor market is a dangerous tightrope, and not one the Fed has demonstrated a capacity to walk well in recent years. Any rational observer might ask a fundamental question. If inflation is tamped down and labor markets are nearing full employment, allegedly, why are we still talking about further rate cuts? The answer is that the U.S. economy might be tipping into recessionary territory after all. According to models by Bloomberg Economics, there's now about a 60% probability that the U.S. enters a recession by mid-2024. Hints of contractions have already emerged. Business inventories are up, corporate profit warnings are flashing, And the golden goose of the American economy, consumer spending, is now wavering. The hit to corporate profits in 2023 has already been dramatic, with earnings growth stumbling across several key sectors. Worse still, sectors often regarded as safe havens of the U.S. economy, such as healthcare and utilities, have been unable to escape the economic slash of tight monetary policy. This perception deepens the business pessimism about pending investments and hiring initiatives. Let's broaden the spectrum a bit, shall we? Any move the Fed makes, especially of the recalibration variety, isn't isolated to American shores. Take emerging markets, for example. Though they recently benefited from capital inflows during the era of zero interest rates, these countries now face outflows and currency depreciation as U.S. rates continue to instill panic into jittery investors. Countries like Argentina, Turkey, and Brazil have all experienced significant currency volatility, just as U.S. interest rates rocketed upwards. The structural fragility of these economies is at risk, adding substantial fiscal strain due to massive repayments on U.S.-denominated debt piles. The knock-on effect could be a deepening of inequality in these societies, further stoking political unrest and economic riots. Trade disruptions due to volatile currency exchange rates would ripple further across borders. Moreover, the global supply chain disruptions induced by both inflation and monetary tightening have already delivered a gut-wrenching blow to international commerce. Retailers in the United States are cutting back on orders from China and other suppliers due to weak domestic demand and higher borrowing costs. The pressure on global markets exacerbates economic instability for everyone engaged in this intricate web of mutual dependency. And speaking of dependency, we cannot overlook the giant elephant in the room: America's rocketing debt burden. Government debt levels between 2020 and 2023 soared past $33 trillion, accelerated both by pandemic-era stimuli and now by interest payments ballooning under higher rates. Servicing this debt is growing costlier than ever. Historically, U.S. Treasury bonds had been regarded as a safe investment, but even the safest havens have their breaking point when economic experiments go haywire. The danger here? Higher interest rates on ever-mounting government debt may ultimately force the U.S. government into sharp reductions in spending on critical programs such as Social Security, Medicare, and defense. All the while, higher interest payments eat up increasingly large chunks of the federal budget. The U.S. debt service level now surpasses $900 billion annually and could surpass $1 trillion over the coming years, particularly if the rate cuts discussed are either too lukewarm or come too late. Note, this won't just affect government programs. It will have cascading effects on the broader economy as borrowing costs for everyone rise, from individual mortgages to corporate loans. As businesses face increased costs of capital, the knock-on effect is less investment in future growth, fewer jobs, and stagnating wages. Let's bring it back home to the American consumer. As everyday Americans scroll through their phones reading endless headlines about inflation, recession, layoffs, and higher interest rates on their mortgages and credit cards, consumer sentiment is trending downward. Feeling insecure about the economic outlook directly reduces household consumption, which still accounts for around 70% of U.S. GDP. According to the University of Michigan's Consumer Sentiment Index, sentiment hit a new low toward the end of 2023, as fears of a recession continued to grow. Consumers are not only spending less, they're saving more, anticipating the worst. So, to bring this all together, is the Federal Reserve recalibrating the economy toward stability? Or are they throwing a lone dart in the dark, hoping to stabilize a shrinking balloon? Daly, like Powell and other Fed influencers, publicly hopes for a delicate soft landing. Still, as we've outlined here, the risks of recession, financial volatility, and long-term instability point to an overcorrection that could batter both American and global markets alike. Behind the shiny veneer of recalibration, there's a broader issue. The Federal Reserve's zigzagging approach to monetary management is sending fragmented signals to everyone from investors to international partners. It's increasingly clear that this isn't just micro-tuning, but rather a sign of profound instability at the heart of policy thinking. America's economy doesn't just need rate adjustments. It needs a coherent, long-term strategy. And we should all worry that if the Federal Reserve continues this back-and-forth approach without a coherent long-term vision, the consequences could be serious, both domestically and internationally. One of the crucial points to consider is this. Is the Fed's obsession with short-term interest rates a symptom of deeper structural issues in the U.S. economy? Many of the problems we're seeing today, rising inequality, stagnating wage growth, an eroding middle class, and jobs that offer little to no security, have been decades in the making. The frequent adjustment of rates is like applying a bandage to a gaping wound. It may slow the bleeding, but it does nothing to heal the underlying issue. While the Federal Reserve spends its time focusing on inflation and employment, the reality of wage stagnation and rising inequality persists. The supposed strength of the labor market has done little to lift wages for millions of American workers. According to a Pew Research Center report from August 2023, despite recent job gains, real wages for most of the U.S. workforce have barely budged over the last 40 years. In other words, while top corporate executives and shareholders have prospered enormously from stock buybacks and rising profits, the average American worker is barely managing to stay afloat. And here's the kicker. The wage growth that the Fed is supposedly aiming to protect through its interest rate cuts is primarily benefiting those at the top of the economic hierarchy. According to the Economic Policy Institute, the top 1% of Americans has seen their wages grow by 160% since 1979, while the bottom 90% have been left in the dust with wage growth of just 26% over the same period. So, even if the Fed's rate cuts temporarily sustain the labor market, are they truly improving the standard of living for the average worker? Or are they merely propping up an already fragile and unequal economic structure? Another structural issue that rate cuts do little to solve is the unsustainable levels of consumer debt. With real wages stagnant and costs of living rising, American households have increasingly relied on credit to maintain their standard of living. As of Q3 2023, American consumers held over $1 trillion in credit card debt, a record high. The Federal Reserve's past rate hikes have raised the interest rates on these debts, making it harder for households to pay them off. And while rate cuts could offer temporary relief, it's far from a solution to the larger issue of precarious consumer finances. Worse still, U.S. household debt, which includes mortgages, car loans, and student loans, stood at $17.3 trillion in 2023. The rising cost of credit could tip millions of already indebted households into delinquency in the event of a recession. Credit card delinquencies had already started ticking up by late 2023, according to data from the Federal Reserve Bank of New York, and this trend will likely worsen if the U.S. economy falters. Another danger that the Fed faces is stoking asset bubbles, particularly in the housing market, which has long been a pressure cooker ready to explode. Since the Fed slashed interest rates to near zero during the COVID-19 pandemic, housing prices surged, increasing by 40% between 2020 and 2022. But as the rates rose again in 2023, mortgage rates shot up to over 7%, drastically reducing affordability for new buyers and hammering anyone looking to refinance. The Fed's actions have distorted the housing market in ways that could have long-term consequences. Regions that saw explosive growth during the past decade, particularly in metropolitan areas like Austin, Texas, or Miami, Florida, are now seeing price corrections. According to Redfin, home prices in some hot markets have already dropped by as much as 15 to 20% from their peak. But it isn't just the housing market that's at risk. The stock market has likewise been artificially propped up by years of both low and fluctuating interest rates. Despite the volatility induced by the Fed's tightening, the S&P 500 recovered much of its losses in 2023, hovering near record highs. This may sound like good news, but the stock market's rise has been increasingly driven by just a handful of massive corporations, primarily in the tech sector. Companies like Apple, Google, Alphabet, Microsoft, Nvidia, and Amazon account for over 25% of the market capitalization of the S&P 500 index. This level of concentration is dangerous. The heavy dependence of equity markets on a few tech behemoths leaves the broader economy vulnerable to a meltdown should these firms stumble due to regulatory challenges, failing demand, or escalating geopolitical risks. Think the ongoing U.S.-China tech Cold War. Let's not forget that whenever the Fed manipulates rates, it's not just impacting U.S. citizens. It's impacting economies across the globe. Many developing nations peg their monetary policies to the dollar or borrow in dollars given the greenback's dominance in international trade and finance. When the Fed raises rates, many of these countries are forced to ratchet up their own rates to prevent investor flight and to stabilize their exchange rates, even if their economies are in no position to handle such hikes. For example, Argentina and Turkey have been continually rocked by currency crises in recent years, exacerbated by higher borrowing costs due in part to Fed policy shifts. This leads to a vicious cycle in which countries are stuck between a rock and a hard place. Either they raise rates and put their domestic economies at risk of recession, or they maintain lower rates and risk capital flight, devaluation, and inflation. Even China, despite being the world's second-largest economy, was not immune to this ripple effect. With the real estate sector in peril and debt levels climbing, Chinese policymakers have had to adjust their monetary stance multiple times in 2023 to navigate fresh headwinds stemming partially from the Fed's hawkish policies. If the restart of interest rate cuts in the U.S. leads to inflation getting out of hand again, the reverberations will be felt worldwide, worsening a crisis that has already made life much harder in economically vulnerable parts of the globe. In the grand game of managing inflation, employment, and interest rates, another critical issue often gets brushed aside: the need for coherent climate policy. The destabilizing impact of climate change on the global economy cannot be overstated. From floods and wildfires to hurricanes and droughts, climate events are increasingly devastating supply chains, agriculture, and energy markets. Yet, the Fed's policy frameworks generally operate in a vacuum, often disconnected from the pressing economic challenges posed by climate disasters. While some regional feds, like the New York Federal Reserve, have published research on the potential economic impacts of climate change, there has been little integration of climate risks into monetary policy projections. For instance, Hurricane Daly, which ravaged the East Coast in 2023, caused billions in damages and actively disrupted several sectors, from retail to logistics. Such disruptions are likely to become more frequent, introducing even more volatility into an already shaky economic system. Moreover, the transition to a green economy, particularly the shift away from fossil fuels, will require substantial public and private investment. Interest rate policies that discourage risk-taking and long-term investment could sharply curtail the pace of infrastructural changes, just when we need those developments to occur most urgently. The Fed, in essence, is perpetuating an outdated financial model that fails to consider the economic necessity of climate resilience. It's vital to remember that the Federal Reserve, even with all its economic clout, is limited in how much it can influence the broader economy. Its tools, mainly interest rate manipulation, are blunt instruments. Over-reliance on monetary policy during times of economic turbulence creates inefficiencies and can exacerbate long-term problems like financial inequality, underinvestment in critical infrastructure, and a bloated financial sector that serves itself more than the broader economy. What truly drives sustainable economic growth and stability are fiscal policies initiated by the U.S. government. That includes targeted government investments, such as infrastructure projects, green energy development, and addressing social security gaps. These projects would have multiplied effects across the economy, creating jobs, bolstering future productivity, and buffering consumers from volatile markets. Unfortunately, the dysfunctional political environment in the U.S. Congress, marked by shutdown showdowns and hyperpolarized debates, leaves very little room for forward-looking investment strategies. The inability to effectively pair monetary and fiscal policy is a recipe for more economic imbalances moving into the future. The current situation, with the Federal Reserve eyeing further interest rate cuts, encapsulates the greater issues plaguing the global economic system. The Fed, in its dual mandate to control inflation and regulate employment, is operating more like a firefighter running from blaze to blaze, rather than a vigilant watchdog proactively preventing emergencies. As we've outlined, interest rate adjustments are at best a temporary salve to much larger structural imbalances. American consumer debt continues to skyrocket, inequality is entrenched, fragile global economies are buckling under every move Jerome Powell and his peers make, climate change looms without sufficient coherent economic planning, and the Fed's policy actions could be laying the groundwork for the next financial crisis. So, is the Fed recalibrating? Or is it charging forward in uncertain territory, hoping for the best while preparing too little for the worst? We'll leave that for history to decide. But one thing is clear: the path forward is full of the uncertainty and risk.